Target just reported earnings, and retail is on fire right now. We have seen the rather bleak outlook from a lot of these retail spaces, specifically Target and Walmart. Target is has a more bleak outlook than Walmart, but it's bad. Anytime that you see Target get hit on a certain day, Walmart get hit on a certain day, you tend to see other retail spaces get hit. Dollar General, Nordstrom, etc. And the list goes on, and these companies just keep getting hammered. So let's see what Target reported. The biggest thing that I noticed was their margins were just absolutely terrible. Right here. Comparable sales growth reflected 2.7% growth in the quarter. Store comparable sales, same store sales, came in at 1.3% increase. Digital, this is a big thing for me. What we saw during COVID with Amazon exploding, Walmart exploding, these guys have a much weaker presence online. It's a good presence, but it's weaker. Grew 9% compared to last year, and last year was 9.9%. So the growth is just continuing for them. They have an incredible delivery service where you can go, you can send a Instacart. They have certain drivers. They'll drop them off to your house depending on what region of the country you live in. But it actually is pretty good. They're doing a very good job with it, but they have a long way to go until they catch up to the Walmart Pluses of the world and the Amazon Prime of the world. Guidance going forward. While the company is planning cautiously for the remainder of the year, current trends support the company's prior guidance for full year revenue growth into the low mid-single digit range and operating margins in the range around 6% in the back half of the year. Remember, what was a major issue for Target? It was inventory. They had so much inventory and they've had to discount the heck out of a lot of big name products. People are not going and just spending frivolously anymore. Well, they are, but they're not going and just buying their TVs and this and that. They are focusing more on essentials, food, toilet paper, paper towels, etc. Whatever you need on a day-to-day basis instead of just going and spending on different things. So the backup with this company, I think they had over $15 billion in inventory, and it increased this year compared to last. It's not the best thing in the world, but again, it's not just with Target. It's kind of sector-wide. Operating income was $321 million in the second quarter, down 87% from 2021, which was $2.5 billion. Now, what I will say about this, is this number bad? Yes, it's really bad. And it's really bad. Now, I have said this on the morning show all the time. If you've been watching for any length of time at 9 a.m. on YouTube, you cannot compare every single number to 2021. For example, if you're looking into AMD, you can't say we did see declines in AMD, but 2021 was one of the biggest years for computers and chips ever. And now they're going back to the normal ways that they saw 2018, 2019. Before that, I don't think you had year-over-year growth in the computer industry as a whole since 2011. So maybe these companies are just getting back to normal after some insane bounce, but that's something that we can look at later and make sure. Either way, 87% is really, really bad. This year's gross margin reflected higher markdown rates, driven primarily by inventory impairments and actions taken to address lower than expected sales in discretionary categories, as well as higher merchandise, inventory shrink, and freight costs. I don't think there was anything else in here. I did pull up a quick story. This was from the CEO of the company that he said on the earnings call, if we hadn't dealt with our excess inventory head on, we could have avoided some short-term pain on the profit line, but that would have hampered our long-term potential. While our quarterly profit took a meaningful step down, our path forward into the future is brighter. So we're going to actually see how that shakes out for them. But I'm going to have to factor that in too when I run the stock analyzer tool and go through this for the company. Even as profits fell, important here, comparable sales and traffic rose. And of course, those internet sales also rose. So a lot of good things coming in here. One really bad thing coming in here. Actually, a couple of bad things. I look at that inventory as pretty bad as well. Let's look at the 8 pillars here, just a brief overlay. Shares outstanding. Depending on when companies buy shares back, when the stock's expensive. I don't know what this company's worth right now, but I have to think that we're more towards the expensive end. And if this was somewhere in the 200 range, which it probably was, why don't I just check it out? Go to metrics here. Yeah, so this thing was well above $250 a share. At that point, if they were buying back shares, I don't love it. I don't love when companies use their money to go and buy shares that aggressively. Dividends, they're paying a hefty amount on their dividends. 5-year free cash flow is $415 billion. 1-year free cash flow, 2.14, and they are paying, of that 2.14, $1.63 billion through dividends. So again, this number, I want to make sure that that's accurate, because if we've looked at other companies in the past, they've paid let's say they paid 1.6 billion, but their free cash flow was 5 billion. We've seen that. Let's just make sure that this isn't just one anomaly year that really screwed everything up. Everything else seems pretty decent. The inventory thing is just crushing me with this company. Let's look at the revenue growth. Okay, here we go. Revenue has just grow small, nothing major. Increased in 2020, no surprise. Really jumped in 21, really jumped in 22. So with these types of revenue jumps from consistently 73, 71, 73, 72, just sitting there, and then you get these big increases, this is more likely than not going to sustain itself, especially if we go into some type of recession. Let's look at their net income. Have they been making money consistently? Again, consistently making money. I would like to go and check out what happened in the year 2015. That was probably some type of maybe an acquisition. Let's see. And then you had these two explosion years of profit. Again, anomaly situations based on COVID? Probably, but let's figure it out. Shares. They've been consistently buying back shares for the past decade. So that makes it, they are very consistent in that category. It's not like they're just buying shares out of nowhere. Total current assets. Now the debt situation here, a lot of their debt could be due to leases of real estate. I mean, they have I'm looking at the lease obligations of $1 billion. So this is actually a pretty good looking balance sheet. Let's check the cash flow. Cash flow is really spiked. Again, really spiked in these 2 years. Average, 5-year average is of their net income is $4.16 billion. I like what I'm seeing here. So overall, I'm actually really liking what I'm seeing from this company. Did they do an acquisition in 15? No. Okay. I don't know what that was. Let's go to, and then again, let's just check the 8 pillars here. Everything is looking pretty good. Now, before I go to Stock Analyzer Tool, this is actually a company that I'm quite interested in, and I'm probably going to go and look at this myself in a little bit deeper dive, especially because we're seeing this hit in stock price lately. But my name is Mo. Paul and I are value investors. What we teach on this channel is a value investing process. We also teach options, process there. We teach trading, process there. We do different topical videos. If this is your first time watching, continue watching us, learn from us. We are here to help you. We both love to teach, and that is our main goal here. So let's go over and run Stock Analyzer and see what I would put in to see what I would pay for this company. So revenue growth going forward. Remember, we've had a couple of years where it's been a little bit frothy on the revenue growth side. They're a big company, $80 billion company. I don't know how much more a Target can grow. I don't know how much more Walmart can grow, Amazon, etc. So I need to factor that in. Revenue growth numbers. I'm going to put in, remember, on the low side, I'm going to stress this thing. I'm going to put in 4%. I'm going to go 4, 7, and 10. I'm going to try to stress this on the low side as much as possible. My middle number is a little bit more realistic, and my high number is best case scenario if this works out. And remember, guys, this is just a starting point for me. Whatever comes up, if this shows all green numbers, it doesn't mean, Mo, just go buy the stock. If it comes up all red, Mo, don't go buy the stock. It's just giving me some idea of where I'm at since I've really liked the balance sheet and income statement. Okay, profit margin. I think that their profit margin could stay pretty consistent. I'm going to go with 4, 5, and 6. I'm going to give them benefit of the doubt. Let's go free cash flow margin of 3, 4, and 5. PE, I'm going to go with 13, 15, and 17. My problem is I don't necessarily know how much more this company can grow. And because it is a Target, I don't see Target going away anytime soon. I think that they're going to remain a big competitor to Walmart and Amazon. I'm going to stick with a 12.5% return. I'm going to stick with a 12.5% return. Why? If I invest my money into SPY, or VOO. On average, throughout history, I'm going to get an average return of 9.9%. So if I'm going to do all the work to go and pick an individual stock like Target and hope that my analysis is right and hope that I'm right in the long run, I need to get a little bit more cream on top of that 9.9%. Therefore, I'm going to put in a 12.5%. If I'm going to look at a company like NEO, for example, there's a lot more unknowns. I know a lot about Target. I know a lot about the history. If I'm going to look at a company like NEO, this number would probably be 20%. 25%, because I really need to make the juice worth the squeeze for the risk. So let's click analyze here, see what comes out. Okay, this is what I suspected. If you're looking at a multiple of earnings, you're somewhere in the 115 to 307 range. Remember, the 307 range is a wide range. It's based on the numbers that I put in here, saying, will this company do 10% revenue growth for the next decade? Will they have a profit margin of 6% for the next decade? Will they give me a 12.5% return on my money for the next decade? Those are things that you can play around with. If you're looking at the discounted free cash flow model, $86 to $256, again, big range. For me, probably looking at this somewhere in that 130 range, probably 130, 135. That's probably where I'm starting to look. And honestly, based on 171, I'm probably going to go look at some puts. I'm going to go and look at to sell some puts on this thing, maybe in November, maybe in December, maybe in January of 2023. And that's where I'm going to go with this one. So if this speaks to you, if you're interested in value investing, if you like my approach, click this video right here. Paul's going to go through a little bit more on value investing to help you. Catch you on the flippity flop.